All right, so we're live. Good afternoon and welcome to the Startup Finance Bootcamp presented by Startup Canada and Intuit Canada. This is the third and final installment of our online Startup Finance Week events. From September 28th to October 4th, we're joining forces with communities across Canada to put the national spotlight on the financial literacy of our Canadian entrepreneurs. Throughout Canada, communities are hosting startup finance events like this to connect entrepreneurs like yourself to tools and knowledge to help your company survive. My name is Renee Tavares, and I'm the program coordinator here at Startup Canada. For those of you who don't know, Startup Canada is a grassroots entrepreneur-led social enterprise with a network of over 100,000 entrepreneurs across Canada. We set out on a mission 3 years ago to build startup communities and are proud to be supporting so many amazing community leaders with resources, networks, and programs to help make Canada a great place to start and grow a business. We are delighted to have two very special guests here with us today, Sahar Ansari and Sarwar Qureshi. Today's bootcamp will be a 60-minute accelerated session where Sahar will let you know about the funding opportunities available to you, and Sarwar will teach you everything about finance, from when to incorporate and how to manage your finances. For those of you tuning in via YouTube or Google+, you can type your questions throughout the presentation, and we will try to get them answered at the end. The hashtag for the event is hashtag Startup Finance. Feel free to tweet throughout the event, okay? Now let's get this bootcamp started. I would like to introduce you all to Sahar. Sahar is one of the co-founders of Fundica, an online funding search platform. Sahar, hi.
Hi.
For the past 5 years, she has been leveraging government and private funding sources to help fund SMBs, successfully preparing and obtaining grants, tax credits, loans, and equity funding for a number of clients. Basically, she's the expert on how you guys are going to get money. So I would like to introduce you all to Sahar. It's all yours, Sahar.
Hi, everyone. Thanks for having me. So today, as Renee just mentioned, I do have a little bit short presentation that we can I will share now. So just make sure. Oops. Okay, so basically what I have here today is a short presentation going over some of the major funding sources in Canada, as well as presenting Fundica, the online search platform that Renee mentioned in the introduction that we've created for businesses in Canada. It's a free tool that allows you to really go further into the search for funding. So I think one important thing to go over before we go further is really what are the different types of funding available to Canadian businesses in Canada. So there are differences between each type. So I just wanted to go over that today. So first, tax credits. So tax credits, something offered by provincial and federal government. It's something that you would apply for at the end of a corporate fiscal year. And so you're always looking back on the year at the expenses incurred and applying for tax credits that would reduce that expense or reduce the taxes owed. So they can either be refundable or non-refundable, refundable being really cash that you would get in the form of a check, and non-refundable being a reduction of your taxes. Second type is really grants. So that's the one we hear a lot about. Grants typically are more competitive. So the way tax credits work is if you do meet certain criteria, you're kind of eligible for them, and so they'll just need to check off the boxes, in which case you'd be eligible. Grants often are more competitive, so there'll be a process you'll be applying for, and then you'll be competing with others who may have applied for the same program. The government typically gives out grants for specific areas of interest of the government, and these are kind of the areas we've highlighted here. So one big one is definitely innovation. So research and development, increasing the innovative platform of Canada. Another area is startups, so growing that sector, kind of helping young entrepreneurs as well as others start companies and grow in terms of creating jobs and other. Export, equipment, so whether you're exporting a product, you're buying equipment. Hiring is another area that there are a lot of small grants for either hiring new grads, for hiring experts, for hiring foreign professionals. Then strategic transactions in specific industries. So these will be kind of areas or pockets where we'll find a number of different grants. The other area would be loans and loan guarantees. So loans we typically understand well just from personal experience, so they work in the same way. Loan guarantees is something different, where either a government or a third-party entity will come and guarantee the loan that you're taking out with the bank. And in the case of default, they would actually take on the risk and say, we'll guarantee up to 75% of the loan, in which case if there is a default, you would personally only have 25% to refund, basically. And then there's equity, so private investors, VCs, and other types, merchant cash advance, and a number of other forms of funding available to entrepreneurs. We're going to kind of focus on the first two here. And go into some of the key programs that are available to startups as well as large multinational companies in Canada and that are fairly well used. So here's a fairly short list, and I'll try to go over them in the time span that we do have. So first and foremost is the SR&ED tax credit. So I have a little bit of a slide on that. So SR&ED stands for Scientific Research Experimental Development Tax Credit. It's one of the most generous programs in the world, the one that we have here in Canada. It really exists in order to encourage innovation and leadership in the country. And it's managed by CRA, so the administrators of the program, as well as by different groups provincially, so in Quebec, say, by Revenue Quebec. In terms of the accessibility, it's a program that's available to both small startups as well as large multinational companies. The rate will, however, depend on the corporate structure and the size of the company. So say federally, the rate will vary between 15 and 35%, and if we combine provincial and federal tax credits, can go up to 75% in terms of a refund, so refundable tax credit for a CCPC, so a small Canadian-controlled company, and the highest rates being in Quebec, Ontario, BC, and then kind of a little bit everywhere else. So that's the SR&ED tax credit. The main focus or the criteria in order to be eligible is that you are undertaking scientific research and experimental development. The three sub-criteria are really: one, that there is an attempt at technological advancement. So you're attempting to advance technology compared to what's readily available and what the knowledge base is within the company. Second, that there is technological uncertainty related to the development that you're undertaking. And third, that there's a systematic approach that is undertaken in order to achieve the advancements sought and overcome the uncertainties faced. So if we can show that those three aspects are present in a project, so it's really a by-project tax credit rather than a by company one, then it would be possible to get tax credits up to, as I was saying, around it's like 74% on the expenses, on salary expenses incurred. So fairly interesting program. Other programs here that I've listed are, so second is the Interactive Digital Media Tax Credit. So this is a provincial tax credit that's offered Quebec, Ontario, British Columbia. That really exists for game developers as well as e-learning applications. So applications that are very interactive, that are either exist to entertain, inform, educate, but really that interactivity component is the major part. And this is fairly well-used program as well. It's the reason why we'll have a lot of the large gaming industries come to the country and set up here. Can go up to around 40% tax credit. Third one I have here is the Industrial Research Assistance Program. This is a grant offered by the NRC. Very similar criteria to the first one discussed, so the SR&ED tax credit, whereby they offer, here in this case, a grant instead of a tax credit. But for the same type of work, so really research and development work, to reduce expenses incurred in that area. So it's a fairly large program, an interesting program, available again, small companies, startups, 1 person, 2 people, up to this one's really focused on the small and medium-sized companies. Fourth one here I have is the programs available through NSERC. So NSERC also has a large number of programs available to tech companies. Some of them are for hiring, so hiring undergraduate students, hiring graduate students, but really to come do research or engineering within the company, so typically to hire science or engineering students, as well as a number of collaborative development R&D programs whereby a company would decide to work with a university to advance research, and grants can go, in that case, up to around $500,000, covering up to 50% of expenses. So that's for NSERC. And then fifth one I have here is, there are a number of young entrepreneur grants available as well as loans. So through local development offices, there are a number of young entrepreneur grants for starting a company that will help reduce expenses related to startup fees. So incorporation, offices, other legal aspects. But the idea is to always remember is that any grant that you will be going to get is always there to reduce expenses. They're not just given out because you're doing something great or because they like your project, but it's really typically you have to present a little bit of a business plan, showcase, what are the expenses that you're going to be incurring by starting up this company, by doing your research, by undertaking this project, and then there will be a program, either a grant or a tax credit that will say, okay, well, if this is how much you're going to be incurring, we are here to support you and we will provide, 20, 30, 40, 50% reduction in your expenses in the form of either a grant or a tax credit. Another program for young entrepreneurs is the Futurepreneur, which is a loan up to $15,000, which once obtained can also be complemented by a loan through the BDC of $30,000, so it can go up to around $45,000 for starting up a company. Last one here I have is a loan guarantee. As I mentioned earlier, kind of loan guarantees, the way they work, they come and reduce the personal risk when taking out a loan. So you would go to a traditional bank and could go and get a loan of up to $200,000, I believe, at this point. And then this program is a government program that would come and guarantee a certain percentage of that loan, in which case you'd be reducing your own personal risk. So this is kind of the overview of a few of the larger programs available, which are interesting. And if you have any questions, of course, we can kind of go through them in more detail. The other thing I wanted to go through today was Fundika. So Fundika is really an online tool available to entrepreneurs in Canada, free. All you have to do is kind of sign up, create an account. Here we see the home page where on the right side you have the sign up information required. So the idea is you put in your email, your password, you put your postal code, your year of incorporation, up to 3 industries that are related to your business, number of employees, revenues, company ownership. And then based on that information, the system actually intelligently filters to identify different sources of funding for the company. So the idea is that you're not just seeing a full list of programs or, hundreds of them, but you're really seeing programs that are tailored to your company. Are you an IT company? Are you a equipment manufacturer? Are you in telecom? And based on your industry, based on the size, whether you're under 5 employees or over 100 employees, it'll filter and identify a program. So here you have kind of a screenshot of what it would look like once you do the search. So once you put in that information, you would come to this page where you would really see a list of the different programs available. I'm not sure if you can see my mouse, but the idea is that there are tabs up here where you can scroll through and go say, okay, what it's identified initially is really 17 grants, 5 tax credits, 62 loans, number of loan guarantees, equity, and advisors. So you would actually click on each one, and then you would see the list of grants, list of loans, and other. And then once you do click on a program that you're interested in, you'll see a one-pager with the link to the program and additional information. So it's really a resource to help you identify what is available to your company, rather than scouring the internet, different federal, provincial, and community websites to see what programs are available. The idea is we try to keep this as up-to-date as possible, as comprehensive as possible. And that information I showed on the first page is really the preliminary information that we would need in order to begin filtering. On the left-hand side of the screen, you see kind of a few of the additional fields that you can use to further filter this list. So we would get into, and I can't scroll down here, but you would indicate if you're exporting, if you're buying equipment, if you're doing R&D, if you're looking to hire, if you're doing a strategic transaction, and based on that, it would actually refilter as you select and refine your search. It'll add and remove programs as required from that list, and then you can kind of see that heart function there. You can shortlist and refer back when you sign back in. So invite you all to kind of check out. You can just go to www.fundica.com and you'll see you can do the search for programs available to your company. So that was my presentation. Thank you for having me. And I mean, we'll go through the Q&A. Feel free to ask any questions or email or contact me afterwards.
Oh, great. Thank you, Sahar. I'm always amazed by all the funding sources that we have here in Canada, actually. And I noticed that when it's speaking to entrepreneurs that a lot of them aren't aware of it. And for all of you out there listening, Fundica is an amazing source. It'll save you a lot of time other than scouring through all of the funding opportunities online. So definitely use it. So we'll move along. If you have any questions for Sahar, please make sure that you comment them in the YouTube channel, and we'll get to them during the question and answers, okay? So now that we've learned how to get some funding, I'll pass it off to Sarwar so we can learn how to make your startup financially sound. Sarwar is a CPA and principal at Patterson & Company based in Ottawa. He works closely with small businesses and he really wants to help them succeed. He offers any expertise on accounting, tax. He's an advisor and mentor to a lot of great startups, and he provides other services to these small businesses. And from speaking to Sawar, I know he definitely has a power or a passion, for helping small businesses, and he really believes that they can change the world. So we're really happy to have you here too, Sarwar. I'll pass it to you now.
Thank you, Renee. Hello, everyone. It's great to be on this conference with Startup Canada. I am just starting to get involved with them, and I'm really looking forward to the opportunities and meeting different types of people that come through the program. So as Renee mentioned, my background is as a chartered accountant, working with small business owners in a variety of capacities. And today the general topic that I'm talking about is to incorporate or not. And that really talks about companies that are in their early stage that are looking at starting their business or have started their business and have a decision to make about how their business might operate, whether it's in a partnership or sole proprietorship, which is also self-employed, depending on the terminology you like to use, or whether you'd like to go ahead and incorporate, and what the pros and cons are of each. So I'll jump straight into that topic, and then from there I'd like to branch off and talk about a couple other things as well. The main reason that I personally like to talk about this is for a lot of small business owners that I meet, they've come to me at a point in time where they've already incorporated, for instance, and when we actually get down to it, the reason for them to have incorporated is not actually based on anything factual. It's more so based on something they heard from someone or they thought it was what was required to start a business. So incorporating is actually a step that you have to take where you're actually creating a company, which is an entity in Canada, and by doing so, you've added on some administrative and legal responsibilities to yourself that come with that. So it's a step that I would say you should take if it's applicable to you from a advantages point of view. If you're not going to be able to do that, then you can avoid the whole step altogether, or for most people, just postpone it. Because what a lot of people might not realize is when you start a business, you could be self-employed or a partnership, and you can operate under that umbrella for as long as you'd like, whether it's a month, a couple months, a year, a couple years, and there is no issue at all with at a time down the road to incorporate and move your business into a corporate entity and then continue along, oftentimes with the same name, the same type of business, and take advantage of the corporation benefits at that time. So in summary, or there are four main points that I'd like to talk about that outline what the advantages are of incorporating. The first one I'll start with relates to legal liability and creditor issues. So when you start off a business as a individual that's self-employed or in a partnership, Sahar in her presentation mentioned certain things with loans having guarantees. So what that means is, as an entrepreneur, when you have creditors such as the bank or other entities that might have lent you money, there is a responsibility on you to pay those funds back if your name or if you've personally guaranteed that funding that you've taken. So that can obviously be a risk and an issue. I have a lot of clients that have business plans where they're looking at taking out small sums of money to taking out large sums of money to helping their business grow. And that's a common thing to help get your business started. I was consulting someone just yesterday and talking to them about a restaurant that they're looking at opening, a restaurant slash coffee shop. So they were just talking about the renovations they need to do to the space. They're looking at signing a lease. They're looking at all the equipment they need to get, and so on and so on and so on in terms of the capital they need to get it started. So the advantage to incorporating, if you can take advantage of it, is the company is a separate legal entity from yourself. So what that means is any obligations that are in the name of the company and the company alone belong to the company and only the company. So if you have a loan in the name of the company, then if something goes wrong and the company is not able to repay that loan, that issue is the issue of the company. So you as the individual could, in a worst case scenario, possibly step away from the company, and the company will then deal with that issue, or if it's not able to pay it, step away from it. Now, I'm speaking at a very high and general level. There are things like personal guarantees. So if you've taken a loan in the company, sometimes the bank will ask you, the individual, to personally guarantee it. And what that means is if the company is not able to repay, you, the individual, can still be on the hook. Sometimes they'll take guarantees from other companies or other individuals, so that will kind of convolute or complicate how the repayment will take place if there is an issue like that. So it's not straightforward, but if you are in a situation where you're looking at agreements, that is something to keep in mind. What are the guarantees? And a lawyer is very, very good at helping you understand those issues. To further elaborate that point is, in certain businesses, there's an inherent risk of operations. The operations that they're running might cause people to have damages or claims against the company. The example I like to use is I have a client that does hot air balloon rides, and the hot air balloon rides that they do are basically putting people into a hot air balloon, taking them on a tour, and sometimes it's a simple tour in a city, and sometimes it's an adventure tour in somewhere remote, like Nunavut, for example. So this individual, in their general day-to-day operations, has an inherent risk because there's people that are traveling, people that are up in the air. There's an opportunity for people to possibly have some kind of injury or issue. So for that individual, that business, the company made sense because having that liability issue separate from the individual was a good idea. It added an extra layer of protection for them. So at a high level, the creditor, the loans, that type of protection, the company entity allows you to add an extra layer between yourself and your business, and it can be useful. So that's the first point. The second point I'd like to jump into, and this is more of my background, is on the tax and the numbers side of it. So the key heading for this term is, or this topic is, tax deferral. And I'll explain what I mean by tax deferral. So I'm in Ontario, I'm in Ottawa right now, so I'll use some rates and some percentages that are applicable here. For those of you that are across Canada, some of the rates that I'm using aren't exactly applicable, but at large, the general concept of what I am talking about is applicable. So in Ontario, if you decide to open up a business and you decide to go the self-employed or partnership route, the income that you make from your business, so when I say income, I'm talking about net income, which is revenues less expenses. The income that you make is taxed at your personal tax rates. Personal tax rates in Canada work on a basically a level by level basis. So depending on the amount of income you make, you're in a tax bracket accordingly. So the higher your income level, the higher your tax bracket, and it just goes up from there. So from a general example point of view, towards the higher end of the range, when you're in the $70,000-$80,000 plus income level, which most business owners probably want to get to if they're not at already, the tax rate in Ontario is approximately 38-39%. I'm rounding and averaging things out here for simplicity's sake. And if you were a little higher in terms of your income, if it was above 120,000, then your tax rate would be higher. If your income was lower, your tax rate would be lower. But for the purposes of our example, we'll use the 38% tax rate in Ontario. So that's what the tax rate is that you're paying on your self-employed or partnership income, if that's the way you're operating. And if I flip that scenario around to talk about companies, if you've decided to incorporate, the corporate tax rate in Ontario for small businesses, and that means a couple of different things. A small business is, for you to qualify for this, it's Canadian owned, firstly, and secondly, it's under $500,000 of income, so the first 500,000, the tax rate on that income is 15.5%. So that's a 2015 number. These rates are obviously, depending on how the elections and different things go, these rates are subject to change depending on the budget and things like that. So if you look at that at a very high level, the tax rate that the company pays is 15.5. The tax rate that the individual pays is 38%. So there's a huge discrepancy and disparity there between what the two sides are. Now, most people might be thinking, I might as well incorporate, pay the low rate of tax, I'll be very roughly 23% better off if I do that, because that's the difference between the 38 and the 15.5. That is true, but that's not entirely true depending upon what you need to do with the money in your company. So what I mean by that is when you have a company, the company is over here and you, the individual, are over here. And what that means is if the company earns income, that income belongs to the company. And if you, the individual, need that money, there needs to be a transfer of that money and wealth from the company to you. So there's a few different ways to do that. The most common and most simplest ways to do that in Canada are, number one, a salary, or number two, a dividend. So what that means is the company treats you like an employee, even though you might be the owner as well, and you can take out a salary just like other employees do. And on that, there are certain things like income taxes withheld and CPP. I'll ignore those for now. And the other one is a dividend. And a dividend is the after-tax profits of a company paid out to the shareholders. So at that stage where you need to take the money out of the company, and this is very common because you, the individual, have personal living expenses like your mortgage, your rent, your car payments. Those things are your responsibilities as an individual. The company cannot pay for those expenses if they're personal in nature because they are not legitimate company expenses. When you take that step of paying yourself a salary or a dividend, you have now created a tax situation where you, the individual, are paying tax on that salary. So if that happens, and for most people they are going to need to take some form of salary or dividends out of their business to support themselves, you are returning to the personal tax rate issue. Because if you, the individual, take $70,000 of salary out of your business, you're going to be paying approximately 38% of tax on that salary. The company will get a deduction and an expense for the amount that you take out, so they won't have to pay tax on that. They'll have a write-off, but you, the individual, will have to pay tax on that. So what I'm trying to say here is if you have a business that's self-employed and making $70,000, and you have an incorporated entity that makes $70,000, which you then take out as a salary, the tax rate on both scenarios is very, very similar. It's exactly the same, actually. I should say exactly the same. Now, the question that some people might have is, what about dividends? Dividends are commonly thought to be cheaper in terms of tax that you have to pay, and that is not the case anymore. That was the case approximately 2 years ago, and before that, the dividend tax rate was a little lower than the salary tax rate, so you could take the money out in the form of a dividend. So what would happen is the company would pay tax, the after-tax profits would then be paid out as a dividend to the shareholder, and then the shareholder, the owner, would pay tax. Now, it's true you're paying two levels of tax, but the two levels of tax are factoring in through a dividend tax credit what you've paid in the company in terms of tax, and you get a credit for that as an individual. So you're not paying double tax, you're paying two types of tax. So a couple years ago, that was the best way to go in terms of pure tax savings. There was a 2-3% differential on the dividend tax rates versus the salary tax rates. But what has happened is, as of now, and going forward for now, the tax rates on dividends and salary are the same. So you could have the similar scenario where the company makes money and then distributes the profits out to the individual for their personal living expenses. And what ends up happening is the individual pays tax that is equal to what you would have paid had you been self-employed and not incorporated. So basically everything I've described kind of makes you think, well, why should I incorporate? The tax rates are the same because I need to take the money out. Yes, that's simply put, that is true. Now, I use the term tax deferral, and tax deferral, what that means is when you are in a situation where you have your business and your business generates more money than you need personally for your personal living expenses and lifestyle, then you have the opportunity to take out less money from your business than what you need to live. So a very simplistic scenario would be you have a business that generates $120,000 of net income in a year, and you, the individual, require $70,000 to live. So you would take that money out either as a salary or dividend, and the remainder, $50,000, would remain inside of the company and would be paid at the low tax rate and reinvested inside of the company. So with that, you could then reinvest that money in the business to help your business grow. You could park that money in some different types of investments and create some kind of portfolio. You could do a variety of different things. You could loan that money to another company if you had other ideas or other businesses that you had wanted to start. So that would be tax deferral because you're paying a low rate of tax now, letting that money grow, and at a time in the future, then you would look at taking that money out. And it could be structured in such a way that it works very similar to an RRSP, for example, where you take some money out now, and then the company has some money left over when you retire, and your personal tax rates go down because you're not working anymore, and then you continue to draw money out of the company to help fund your lifestyle at that time. So that's what tax deferral means. For a lot of small businesses, a lot of startups that I meet, tax deferral is a dream or a goal. They're not necessarily there right this second, especially when they're starting up. A lot of companies that I meet, if $70,000 is their requirement for what they need to live on personally, they're actually making $60,000, let's say. So they're actually in the red, which means they're actually losing $10,000 and using up, let's say, their savings or some funding, loans from family and friends. So that type of scenario is applicable when your business has gotten to the point where it's profitable and it's past the point of earning more than what you need personally. So that's tax deferral. So the first one we talked about was the liability issue. The second one we've talked about is the tax deferral. The third one that we'll get into is what's called income splitting. So income splitting is an opportunity with Canadian companies to utilize possibly members of your family, possibly friends, possibly colleagues and acquaintances that you might have to help take money out of a company and utilize other people in your circle who have low tax rates. Now, in all honesty, this is usually mainly and only applicable to people within their family circle, because if you have a business that has, let's say, $120,000 of income, the people that you might be willing to consider income splitting that money with are probably people that are in your household and in your family. So perhaps your spouse, perhaps your kids, perhaps your parents, perhaps siblings. Those would be the most common examples. It would possibly, but not very likely, extend to family and extended family and friends, because those types of people, if you do happen to pay them out of the company and then they have that money, then it creates a certain situation where you need to then figure out a way of getting that money back and having that relationship where you can do that. That's not always going to work out with big sums of money being paid out to people that you aren't really, really close with. So how that works is you, the individual, you have a business, and your business is once again hopefully profitable and generating some kind of income, and you're looking at your family situation in terms of how much money your family needs to live on, And when you have a family, the household expenses of the family can be paid by spouse number one or spouse number two. It doesn't really matter which spouse takes care of the mortgage, for example, or the rental payment. So the company can then pay out to spouse number one or spouse number two arbitrarily to take advantage of if one spouse is in a higher tax bracket than the other. A very common scenario I come across is there's the entrepreneur and they have the business and their business is making a certain sum of money and their spouse could be working in some kind of job and that job is generating a certain amount of income, and let's say that income, for example's sake, is $50,000, and the entrepreneur with their business is at a much higher level of earnings. So they potentially have $200,000 of money they can take out from their business. So if they take out $200,000 from their business and pay tax on that personally, they're going to be in a very, very high tax rate, and their spouse will be at $50,000. The reverse scenario could be that they need to take out $200,000, but their spouse is already at 50, so they would balance the amounts between the two spouses to reflect the $250,000 that the family needs to come out of the company. So both spouses would be, let's say, at $125,000 each. I haven't done the calculation in my notes or in my head, but I know for a fact that if you did do that calculation, the tax on that two different scenarios would be greatly less if you were splitting and utilizing the tax rates in that way than if you had one person earning a lot more and one person earning the 50,000. So the reason you can do that with the company is because when you create a company, you have control over who the shareholders are of your company. So at the time of incorporation or even later on, there is certain things you can do with the shares of your company in terms of who owns them. So that's really where a tax accountant and accountants get involved and lawyers get involved to help make sure it's structured properly. That's the term that we most often hear. So these people would get involved and make sure that, for instance, those other people that you would think of income splitting with were shareholders of your company. Therefore, you could then pay a dividend. And once you're a shareholder of a business, whether or not you are actively involved in the business, like you could be there day to day, or you could just be a shareholder but not do anything, more or less, you can still get a dividend in both scenarios. And the dividend doesn't have to be equal or in any kind of relation to the amount of work you put in. And if you structure it properly, you could have different family members earning different dividends. So you can have dividend to spouse one, no dividend to spouse two, and a different amount of dividends to child number one if you structure that properly. That structure is really, really important, and that's where accountants get involved. It's probably beyond the scope of what I can cover in 5 or 10 minutes, but what I will say is it is possible to income split with different people in your family, and speaking to your accountant about that is useful. Now, the reason why you can do that in a company, I've kind of explained, but the reason why you cannot do that when you're self-employed is because when you're self-employed, there is no concept of dividends because there is no such thing as after-tax profits of the company. So when you're self-employed, the only thing you can consider doing is possibly paying a salary or a management fee to other people in your family to help with that income splitting scenario. The main challenge that holds a lot of my clients back from doing that is a salary or management fee is only payable and applicable when it relates to work that was done for the services that are being paid for. So for example, if you have a spouse or a child and you'd like to give them $60,000 from your business and you're self-employed, then that amount has to correspond to the work that they do. So if they did certain tasks for your business and that's the value of those tasks, the market value of what you would have to pay to hire someone to do that, then that's great. You can certainly do that and then the income splitting is applicable. But if they're not really involved and they're not really doing something of that value, then you would have an issue if it was challenged by CRA to say, why did this person earn $60,000? All they did was, they cleaned up the desk and they made a couple phone calls throughout the year. So that could be an issue. So the income splitting opportunities for a company are great. But once again, similar to point number two, it's applicable at that point in time when the company is profitable. Because if the company is not profitable, then there's not really going to be money to take out. So the points that we've covered so far are the liability and the creditor proofing through a company, the tax deferral, and the third one we just covered was income splitting. The fourth one is and this is new. I didn't actually used to consider this as a reason to incorporate until recently, but the fourth one is the funding opportunities and the grant opportunities. So Sahar talked about some of the grant opportunities and funding opportunities in her presentation, and as you can imagine, there's a lot of different government and other programs out there that could allow you to access some of those grants. And I'm a firm believer that if you can get some grant money or you can get some funding opportunities that don't hinder your business, then you should explore those. And in helping clients do that in those applications and processes, I've come to see that a lot of them require you, the business owner, to have an incorporated entity that is getting the funding. I see that to be very, very common. Not always. You can still get some funding and some grants through a self-employed venture, but a lot of cases you have to be incorporated. So I would argue that if you have the opportunity to get a grant, that if that grant requires you to be incorporated, then you should strongly consider incorporating, because that grant could be, depending on the terms and what have you, free money, quote unquote, if it, it's depending on the terms and if you don't have to pay it back. So that is definitely something you should look into and take advantage of if you can. I would also add a sub point to the funding and grant opportunities, and that would be possibly the people you're dealing with, your customers and your vendors. There's some people, depending upon the type of work they're trying to do. For example, if you're trying to do consulting for the government, that your people that are hiring you, they might require you to be incorporated. Otherwise, they will not deal with you. And for example, IT consultants are an example of that. The government will not hire you in certain roles if you're not incorporated. So if the decision is get this client and be incorporated, or don't get this client and don't incorporate, and you're looking to find a client, you might as well incorporate and get that client. So that's the fourth point. I'll go over the 4 points once again. The first one is the liability and creditor proofing. The second one is the income tax deferral. Oh, and pardon me, the second one is income tax deferral. The third one is the income splitting opportunities, and the fourth one is the funding and the grant opportunities. So if any of those, it doesn't have to be all, if any of those are applicable, you should consider incorporating. In terms of an account and the role they play, they're usually involved with companies from the very, very start. So if someone comes to me and they're thinking of incorporating, I can help them with certain things like share structure, which we talked about being beneficial to pay out family members. And oftentimes I advise people on that. However, a lot of people come after that fact. They've come a year after they've incorporated. So then an accountant can help with things like, once you have a company up and running, you have to file corporate tax returns. You might have to do accounting and bookkeeping. You have to file HST returns, things like that. So an accountant can jump in and help with all those tasks. So I will leave it at that for the incorporation, to incorporate or not side of things. And hopefully in the question and answer, we'll be able to get a little more deeply into some of these issues and some other issues as well. I'll turn it back over to you, Renee.
Thank you, Sarwar. That was great. It was really good to learn a little bit more about why we should incorporate, which is interesting. Like the income tax deferral stuff is always something that interests me, and like all of the changes that have been made to the dividends laws and stuff. So I guess at this time we'll open it up to questions and answers from our participants. You can share your questions using the comment section on Google Plus and on YouTube, or by tweeting at startup_Canada using the hashtag Startup Finance. We do have one question right now from Serena Dallas. She commented on YouTube, and it's for you, Sahar. Do you have to be incorporated to access Fundica, or for some of the opportunities on Fundica?
Sorry, I was on mute there. Yeah, so that's a good question. I think Sarwar kind of mentioned that at the end of his presentation. So it really depends on the programs. A lot of many of them will require incorporation, but I think the idea is to, if you're kind of looking at, do I incorporate or not, and Sarwar obviously went over that, I think it's important to look into what is available, and that's kind of what Fundica is there for. And although we do ask for an incorporation year in the creation of account segment part of it, the idea is if you're looking at incorporating, you would basically put it in this year. So what we're trying to see is whether or not you've been incorporated for over a year or two, in which case you kind of fall into a different category, or different programs become available or not available to you. So it's more of a filtering mechanism than anything. But the short answer is For some programs, definitely it will be a requirement, so they will actually state that in the requirements and require you to show the incorporation documents when applying. And for others, it won't, where it will be, for self-employment or self-employed companies to be able to have access to grants.
Okay. Do we know the reason why some grants usually want the company to be incorporated, or is there a reason?
I'm not quite sure, actually.
Okay.
That's a good question. I mean, yeah, I could kind of venture into why in my own, but the true answer I wouldn't be able to give. Yeah.
Okay, that's perfect. Well, so Sarwar, you mentioned some reasons why people should incorporate, and one of them being the grant opportunities that they're restricted from if they're not incorporated. But is there another reason you would suggest the company to just stay away from incorporation?
Yeah, so in my experience, if some of those points that I'd mentioned, if the grants are not available, your customers are not requiring it, you're starting up, so you don't really have those profits and all those other reasons I mentioned, then
Yeah.
I would say don't incorporate because the whole process of incorporating creates, number one, a cost. So there's a cost to incorporate. So if you go on Industry Canada website and try to incorporate yourself, there's a cost. If you try to see a lawyer to get the lawyer to help you incorporate, there's an increased cost because the lawyer's professional fees will be involved. And once you have incorporated, you've created this. Think of it as creating a person. You've created another person, so now you've created a whole set of additional tax returns and filings that you then have to do. And I've come across a lot of people that have incorporated, and when we went through those analysis that I did, it turned out that they didn't need to incorporate. So then the question came up, well, can I close my company? And the answer is yes, but with the cost as well. So then they had to see a lawyer and get a dissolution and things like that to do that process, which means you've kind of gone down a path of unnecessary resources, using unnecessary resources, where if you can just hang out, be self-employed for a while, make that decision whenever the time comes. It's very, very easy. It's like flipping a light switch. There's a couple forms and things that get filled out, but at that time you can get incorporated. It's much easier to do that than to go backwards from being incorporated to not.
Okay, perfect. And so you mentioned when you basically become incorporated that there's a lot of extra work. At what point was it right for a small business to bring on an accountant or bookkeeper to deal with that?
So that's a great question, and I'll talk a little bit about that as well as just what accountants and bookkeepers do, just to clarify some of their roles. So I'll start with that. The bookkeepers generally are people that help with the day-to-day data entry that needs to go into a business. So once you've incorporated or once you started a business, even as a self-employed individual, there is a requirement for you to keep track of your earnings, your expenses, and things like that. So a bookkeeper is someone that helps with that data entry. And an accountant can also sometimes do that type of work, and an accountant is usually from that point on. So taking that data entry and taking that data and using that to file taxes, to help with tax strategies, to help with forecasting, cash flow, talking to banks, things like that. So depending on the business you're in, depending on the resources you have, depending on your knowledge level, the answers can vary. There are a lot of individuals that I feel like are capable of doing their own bookkeeping, and I think you as an individual make that decision based on, for example, some people do their own taxes and some people don't do their own taxes. So, if you're comfortable with doing certain things like that, then you can likely train yourself. I believe there's a lot of resources on and through Startup Canada and other organizations that can help with how to do your own bookkeeping and certain things like that, which Renee can comment on. And if you're good with that, then I would say you can probably do your own record keeping and avoid getting a bookkeeper. But if you don't feel comfortable with that, then a bookkeeper would help with that. And to add to the accountant's role, when it comes time to file your taxes, if you've been filing your own personal taxes and you're comfortable with that, you can probably file your own self-employed taxes, which is through your personal tax return. On the incorporated side, filing a corporate tax return is probably beyond the scope of what an individual would want to do themselves. And the main reason I say that is there is a barrier to entry, which is just getting your hands on the accounting software to be able to do your taxes. So in that regard, it's usually easier to just get an accountant and pay their fees because they already have the software to then help you with their corporate taxes.
Okay, perfect. Thank you, Sarwar. So I just got another question about incorporation. They were wondering how much is like, or what's a rough idea of the total cost from sole proprietorship to become a business?
So that is a great question. The cost, and this is a case by case basis, can vary. So the simplest scenario is an individual is incorporating and it's a brand new business, like it hasn't had any operations in the past and they're just starting from scratch, so to speak. So in those types of scenarios, you can either go on the Industry Canada website and incorporate yourself. I believe there's a certain cost. I believe it's $200 to register your company. And from there, there's some other small costs and you're up and running and you have your company after that. If you want to get a lawyer, there's people here probably across Canada and the fees can vary. I'm here in Ottawa. I've seen here if a lawyer were to do the incorporation and help with their professional expertise, and in my experience, it's usually a good idea to have a lawyer help out. I've seen the lawyer's fees range from 500 to 1500, and that being a good ballpark for how they can help. So that will be the front end cost in terms of your cost to enter. Then once you've entered, then there's ongoing costs. We talked about bookkeepers if you need to get one, and the accountant that might need to do your tax return. The tax returns can vary once again. The firm I work in for Ontario companies, the average annual corporate tax rate is $1,000. So a little above, a little below, but use that as a ballpark figure. So those would kind of give you an idea of your upfront cost and then your annual cost thereafter, because the tax return would be a year-over-year requirement.
Okay, perfect. Thank you. And Sahar, I just got a question for you. It's about grants. A lot of programs look at cash flow analysis and projections. What advice would you give to showing that? And I know Sarwar can also provide some insight on this too. So this is a great question for both of you.
Yeah, so I think that's very true. So depending on, as I was mentioning earlier too, with grants, they're always really there to help reduce expenses. So what they do often ask for is, what will be your cash flow? What are the expenses that you're expecting to incur? And typically they'll ask for forecasts between 3 to 5 years, depending on the size of the grant that you're looking to go get. One important thing is, when you're doing the search for grants and you do identify something, one thing that's important, I think, for everyone to do, and it's really just draft copy, is put together a short business plan. It doesn't need to be anything elaborate. It doesn't need to be professionally done, but really putting down your ideas on paper, deciding, what is our plan over the next, month, 6 months, but as well longer term. What type of projects do we plan to undertake, and where will our expenses be incurred. So I think in terms of the question itself, what they're asking for is to understand, where is your business going? What will you be doing with the grant money or the tax credit, whatever money it is that you're receiving? They will understand where will it be spent, and they're trying to identify as well that you're in line with some of the benefits to Canada, say, that a lot of these grants are looking to bring in. So things like hiring of employees, things like increased growth in Canada and innovation and others. So if through those through the projections, you can somewhat show that. So yes, if we do see kind of our cash flow increase, well, we're going to need more people to support this, and we're going to need to bring on other people into the team with maybe certain expertise. That's important to showcase. But at the end of the day, you want to be as realistic as possible as well. Forecasts are always kind of a guessing game to a certain extent. So there's no way to avoid that, but you want to be as true. And at the same time, as you grow, there might be new opportunities for funding or grants or tax credits or others. So keeping that in the forecast as well is important, I think, because it can help showcase a healthier financial situation.
Oh, great. Thank you. Sarwar, do you have anything to add to that? That was a pretty great answer, so pretty informative there.
It was. I'll add a little bit to it. In my experience with cash flow statements, and a lot of people come to me as an accountant to help either put together their cash flow statement or just review it. I'll offer a couple little pieces of advice. The first one is in the cash flow statements that I've seen, almost all of them are usually done in Excel or some kind of template. So at the top of the spreadsheet, you'll have the numerical considerations. And sometimes people forget this, but the bottom of the spreadsheet, you should have some footnotes that tie in to all of the things that you are commenting on in your estimate. So for example, if you were opening a spa and your first year or your first month's revenues were I'm just making this up, your first month's revenues were $10,000, your footnote should include that means we are selling 30 services at this price, and that will kind of help support why your number is that. And then as you get into year 2, 3, 4, 5, or month 2, 3, 4, 5, you can then show a relationship of I think I'll get this many services and this many customers, and how you extrapolate that over the 5 years. Then from there, I would say show the interrelationship and consider for the different types of accounts. So for example, if your sales are going to be a certain amount on your cash flow statement, then to provide those services, like those massages for instance, then there has to be a correlation to your salaries expense if you're hiring people to provide those massages. And if your number of massages doubles from year 1 to year number 4, then in my mind, your salary should double from year 1 to year number 4, unless you, the owner, are providing a lot of massages and you're not paying yourself a salary. And that should all be explained in how you go through your commentary.
Okay, perfect. So commentary and explaining everything is really important when we're looking at the grant application, right? Oh,
Yeah.
perfect. So we have another question about incorporating. Do you know the difference between incorporating federally versus provincially? And what are the benefits of the two of them?
Yes, yes, I definitely do. So the provincial incorporation generally binds you or restricts you to operating within that province that you're incorporating within. So if your plans are just to be within that area, that geographical area, then incorporate provincially. If you're incorporating federally, then the reverse is true, where you're able to operate your business all across Canada. So if you're going to be doing business all across Canada, do that. If you're not sure, I would say incorporate federally. It just gives you better coverage. And here in Ontario, it's actually very slightly cheaper to incorporate federally. So most of the clients that I deal with, if they haven't made that decision themselves, I just say go for the federal option. It's a little cheaper and you have more flexibility. That might vary in your province, but a lawyer or an accountant might be able to comment on that from your jurisdiction.
Okay, thank you. And one more question for you, Sahar. How does an entrepreneur know what type of finance they should consider getting?
So that's a good question. I think at the beginning of my presentation, I went over kind of the general big different types. I think definitely when you're approaching, obviously there's the whole business side of what you're doing, how you're doing, the market and whatnot. But once you do go into the finance side and how I'm going to finance this business, the idea is to start with the low-hanging fruit, which is not necessarily go for loans or equity first, which you either have to repay or are giving away a portion of your company, but really investigate first, I would say, grants and tax credits that will be available to you. So, and other important thing to remember is that with grants, you always have to apply before you incur the expense. So the idea is you actually have to plan for it and apply and receive the acceptance letter or whatnot. In which case then you would incur the expense and then you would be refunded for that expense. So there's quite a bit of planning involved for that. But really the idea, I think, going back is low-hanging fruit is the grants and the tax credits. The tax credits work a bit differently where you're always looking back on the year. So you would incur the expense and then wait till the end of your year in order to go get the refund. But that would be where I would focus the search initially. And then once you identify that platform of what is available there, then if you need more, could go investigate, the banks, the private investors, and other available funding.
Oh, okay, perfect. Thank you. Actually, I didn't realize the whole future looking for grants and then for tax incentives, it's looking backwards. So that's actually an interesting point.
Right, and quite important, actually, because I've met with clients where they'll be like, we just hired this person and he would have fit perfectly into this grant, and unfortunately, because it's been done already, we can't go back. So.
Wow.
Important to kind of do that search beforehand.
Yeah, definitely. Well, I guess we're getting to the end of the program, so we'll wrap up the question and answer period. It's been really informative, though, so thank you both for answering those questions. I hope that all of you watching were able to walk away with some great information on getting funding and what to consider when incorporating and setting up your tax structure. On behalf of Startup Canada and Intuit Canada, thank you for attending this online Startup Finance Bootcamp. To receive your 50% off promo code from QuickBooks Online, be sure to register. There's a link in the description below, so make sure you get that. And if you still have questions for our very special guests, send an email to hello@startupcan.ca and we will connect you to them, okay? On another note, Startup Canada has two major announcements today, so please be sure to stay tuned to our Twitter account, startup_Canada. You don't want to miss out on these announcements, and we hope that you'll be a part of the celebration online. All right. Another big thank you to Sarwar and Sahar. I'm loving the name chemistry there. For volunteering their
Thank you.
time.
Thank you.
Yeah, we really appreciate you guys volunteering your time to help out with this session. So thank you again. We appreciate it. All right,
My
everyone, have an
pleasure. Thank
enterprising
you.
day.
Bye.
Bye.